Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Great to be here.
Today, we're breaking down one of the absolute titans of the financial world, Bank of America Corporation, ticker symbol BAC.
A household name, really.
It really is.
Mhm.
Now, on the surface, it's this massive, seemingly stable institution. But the real question for us as long-term investors is this. How strong is that fortress, really? And are there opportunities or perhaps hidden risks the market might be missing? That's what we're here to find out.
That's a massive question. And before we really dive into the nuts and bolts, just a quick note for everyone watching or listening.
Yeah, absolutely. For those who want to act on these investing ideas, having a professional-grade platform is, well, pretty key. We personally use Interactive Brokers,
Yeah.
and we've partnered with them to get our viewers a stock bonus when they sign up using our link.
Right, so you get a bonus for trying them out, and it also helps support the channel directly. Win-win. That link is right down there in the description, correct?
That's right. It is. And of course, if you find value in this kind of, really in-depth discussion, the best way to let us know, make sure you catch the next one, is simply to subscribe and like the video. It genuinely helps the channel reach more people.
And definitely, if you have questions about Bank of America or any thoughts as we go, drop them in the comments section below. We do read them.
We absolutely do. Perfect. Now let's get into it. Pillar number 1, the business model. Let's really get to grips with how Bank of America actually makes money.
Okay. So, at its core, Bank of America operates as what's called a universal bank.
Right. Sometimes called a financial supermarket.
Exactly. It basically serves three huge client groups. Individuals, regular consumers.
Like us.
Yep. Then companies, everything from tiny startups right up to massive global corporations. And finally, institutional investors, think pension funds, hedge funds, things like that.
And despite that massive reach, the way they actually generate revenue is, maybe surprisingly, pretty straightforward at its heart. It really comes down to two main pillars.
It does. The first one, and historically the biggest profit engine, is net interest income. NII, you'll hear it called.
NII, right, the classic banking spread.
Precisely. Think of it as the difference, the spread, between the interest the bank earns on its assets, mostly loans it makes, mortgages, car loans, business loans, plus interest from securities it holds,
Good.
and the interest it pays out on its liabilities. And the biggest liability by far is customer deposits.
So the money people like us keep in our checking and savings accounts.
Exactly. And in 2023, for instance, higher interest rates were actually a big positive for their NII because that spread, the difference between what they earned and what they paid, widened quite a bit.
Makes sense. They're essentially borrowing low, mostly from depositors, and lending higher.
That's the fundamental model. Money is their raw material, and NII is their gross margin on that material, basically.
Okay, so NII is pillar 1. But they don't only make money from lending, right? There's the other big piece.
Pillar 2 is non-interest income. You'll often hear it called fee income.
Fee income. Got it.
And this is really diverse. It covers all the money they make from services that aren't directly tied to that core deposit-taking and lending function.
And this comes from all their divisions.
Pretty much all four main business segments, yeah. Consumer banking, global wealth and investment management, GWIM, they call it internally.
GWIM, okay. Includes Merrill Lynch.
Right. Then global banking, serving larger companies, and global markets, which is their sales and trading arm.
So what kinds of fees are we talking about? Give us some examples.
Oh, it's a huge range. It could be the monthly maintenance fee on your checking account.
Yep, familiar with those.
Or at the other end of the scale, massive advisory fees for helping a company with a merger or an IPO.
Investment banking fees.
Exactly. Then there are asset management fees, like what Merrill charges clients based on the amount of money they manage for them. And of course, revenue from trading activities in global markets. It's a really broad mix.
So a significant and, importantly, a diversified income stream beyond just interest rates.
Very important. And structurally, beneath those four big segments, they actually have 8 distinct lines of business.
8.
And that structure isn't just for show. It's designed to enable what they call their integrated strategy.
The one company approach, right?
That's the phrase they use. The whole idea is to systematically deepen relationships with customers they already have, and, crucially, to cross-sell them more products and services.
So get the checking account customer to also take out a mortgage, maybe open an investment account.
Precisely. Let's imagine a small business owner. They might start with just a personal checking account in the consumer bank.
Okay.
Then, as their business grows, they get a business loan through global banking. Maybe later they start building personal wealth, and their local branch advisor introduces them to a Merrill advisor under GWIM for retirement planning.
Ah, so it's all interconnected.
Completely,
Yeah.
all under that single Bank of America umbrella. That deep integration is absolutely central. It creates this powerful network effect. Each product kind of reinforces the relationship.
Okay, that makes sense. Now, what strikes me about this whole model, taking deposits, making loans, offering services, is how simple it is at its core and how long it's been around.
It's incredibly simple fundamentally, isn't it? Banking is one of the oldest commercial activities, taking money from those who have it and lending it to those who need it.
A foundational economic need, secure storage for capital, efficient allocation.
Absolutely. And that intelligibility, that basic understandability is actually a huge plus for investors. It connects right back to Munger's idea of the circle of competence.
You want to understand the business you own.
Exactly. And banking, at its heart, is understandable.
And it seems incredibly durable, too. Is this a business model that's likely to be around for decades more?
It's hard to imagine a future where it isn't it? People and businesses will always need a safe place for their money.
Always.
They'll always need ways to make payments. They'll always need credit for homes, cars, business expansion.
And wealth management as people accumulate assets.
Absolutely. Now, the way these services are delivered, that definitely evolves. We've gone from just branches to sophisticated apps.
Right. The delivery method changes.
But those fundamental human and commercial needs, they seem pretty constant. And Bank of America's strategy, what they call high-tech, high-touch, directly addresses this.
High-tech, high-touch, meaning
Meaning they're investing billions in digital, the app, online banking, AI like Erica. But they also maintain that extensive physical branch network because many customers still value that face-to-face interaction, especially for complex things.
so balancing the digital with the physical.
Exactly. And look how successfully they integrated Merrill Lynch after the financial crisis. That positioned them perfectly to capitalize on the huge trend of wealth accumulation in the U.S. It shows they can adapt.
That adaptability is key. Now, you mentioned the financial crisis. If you listen to Brian Moynihan, the CEO, you constantly hear this phrase, responsible growth. What does that actually mean in practice? It sounds like corporate speak.
It might sound like it, but in this case, it's actually deeply meaningful. It represents a fundamental strategic shift, almost a refounding of the bank post-2008.
Okay, how so?
Remember, pre-crisis, Bank of America grew aggressively, sometimes recklessly, through huge acquisitions like Countrywide Financial.
Right, which almost sank them.
Exactly.
Yeah.
Responsible growth is the absolute rejection of that model. It's about de-risking, simplifying the company, and focusing intently on steady, organic growth from their existing customers.
So less empire building, more cultivating what they already have.
Precisely. Moynihan took over in January 2010, inheriting a mess. Legal issues, reputational damage, massive complexity. So when he talks about growing within our risk framework or sustainability or operational excellence,
That's the language of someone who's stared into the abyss.
you could say that. It's about building resilience, correcting those past mistakes, the excessive risk, the complexity, the bad M&A. And frankly, for a company to be a potential long-term holding, that kind of discipline, that prioritization of stability is non-negotiable. It's foundational.
Okay, that provides crucial context. So we have this understandable, durable, and now arguably more disciplined business model. Let's talk about its defenses, the economic moat.
Right, the competitive fortress. And independent researchers like Morningstar agree it's strong. They rate Bank of America's moat as wide.
Wide moat, which usually implies strong, sustainable competitive advantages.
Exactly. And in BAC's case, it really stems from two primary reinforcing sources. Classic moat stuff, really.
Okay, what's the first one?
The biggest one, arguably, is cost advantages driven by sheer scale.
Just being enormous.
Enormous. They are #1 in U.S. consumer deposits. Think about that. They have privileged access to this vast, stable, and incredibly low-cost pool of funding.
Billions and billions in checking accounts paying next to nothing in interest.
Precisely. That gives them a structural cost advantage over smaller banks or non-bank lenders who have to borrow money in more expensive wholesale markets.
So their raw material money is cheaper.
Fundamentally cheaper. And then, because they're so big, They can spread their huge fixed costs, things like their multi-billion-dollar annual tech spend, national advertising, massive regulatory compliance burden.
Which must be staggering for a bank that size.
Oh, it is. They spread all that over a much larger revenue base. This drives down their cost per customer, their unit costs, creating operating efficiencies smaller players just can't replicate.
It's a classic scale advantage flywheel. Scale leads to lower costs, which lets them compete better, which attracts more scale.
You got it. That's the first pillar of the moat.
Okay, what's the second one?
High switching costs.
Making it painful for customers to leave.
Exactly, especially for their most integrated customers. Moving banks isn't just inconvenient, it can be incredibly difficult and disruptive.
Not just financially, but logistically, mentally.
All of the above. Imagine you have your checking, your mortgage, a couple of credit cards, maybe your Merrill investment portfolio, all with BAC. You're not just a customer, you're deeply enmeshed in their ecosystem.
Tied in.
Very much so. And they actively reinforce this with programs like Preferred Rewards.
Right, where you get better perks the more business you do with them.
Exactly. Tangible benefits, fee waivers, better reward points, lower loan rates. But, and this is key, those benefits are contingent on maintaining those multiple relationships and asset levels.
So if you leave, you lose the perk.
You forfeit them. It's a subtle but very powerful incentive to stay put. It raises the cost of switching even higher.
Let's make that real. Walk us through an example of how this moat works in practice.
Okay, perfect. Let's picture a successful small business owner, maybe in Charlotte, North Carolina, BAC's home turf.
Right.
They probably started years ago with just a personal checking account at a local branch. Simple start.
Makes sense.
As their business takes off, they open a business checking account, maybe get a line of credit from the bank. And because BAC has that low-cost deposit funding we talked about,
They can offer competitive rates on that loan.
exactly, scale advantage in action. Now, this owner is busy, tech-savvy. They start relying heavily on the BAC mobile app for personal stuff, and maybe the Cash Pro platform for their business finances, payments, cash flow management.
Okay, getting more integrated.
Deeper and deeper. Then, as their business succeeds and they build personal wealth, maybe a financial solutions advisor at their branch using that integrated one-company approach.
Sees an opportunity.
And smoothly introduces them to a Merrill advisor for wealth management, retirement planning, maybe even estate planning down the road.
Wow. So suddenly their whole financial life, personal, business, investments, it's all within Bank of America.
Completely consolidated. Now, could some local credit union offer a slightly higher rate on a CD? Could a new fintech app have one cool feature BAC doesn't? Maybe.
Theoretically, sure.
But think about the practical reality. To switch, that business owner would have to untangle this incredibly complex web of accounts, reroute bill payments, payroll, renegotiate loans, transfer investments, build new relationships.
It sounds exhausting just thinking about it.
It's prohibitively costly in terms of time, hassle, and just psychological energy. That smaller competitor simply cannot replicate the breadth of service, the digital convenience, the physical presence, and the established trust BAC has built.
So the ecosystem itself becomes the defense. It repels competitors.
And it allows BAC to keep those profitable customers and sell them even more over time. It's a powerful dynamic.
And is this moat stable, or is it changing, getting stronger or weaker?
We actually see signs it might be widening, particularly because of technology.
Interesting. You often hear about tech disrupting banks.
Right, but for the giants like BAC, it can actually be a Moat-Widener. They're pouring, what, $3 billion, $4 billion a year into tech.
That's a staggering amount, more than the total value of many smaller banks.
Exactly. Regional banks, fintech startups, they just cannot match that scale of investment year after year, and that money translates directly into a better digital experience.
Like their mobile app, which always gets high ratings, or Erica, the AI assistant.
Precisely. These tools don't just attract new customers, they make the bank stickier for existing ones. They increase those switching costs further by embedding the bank into daily life. It leverages their scale.
So tech reinforces the scale advantage.
In this case, yes. And there's another factor strengthening the fortress, especially in uncertain times.
What's that?
The flight to quality.
When things get scary, money flows to the biggest, safest perceived players.
Exactly. Think about the regional banking turmoil we saw recently. What happened? Depositors, both individuals and businesses, got nervous and moved huge sums of money into the giant banks like Bank of America.
Because they're seen as too big to fail, implicitly or explicitly backed by the government.
Right. They're perceived as the safest place to park cash, and that influx of deposits further lowers BAC's funding costs, strengthening their core cost advantage.
So instability actually reinforces their moat. Scale begets more scale, and perceived safety attracts more capital.
It's a powerful, virtuous cycle, especially during periods of stress.
It really highlights Munger's point about scale economies, doesn't it?
Yeah.
Being that big creates almost insurmountable hurdles.
It's a textbook example. That coast-to-coast network, 3,700 centers, 15,000 ATMs, #1 in deposits, 69 million customers. It creates a cost structure smaller players can't touch.
Enabling competitive prices and good returns.
That's the power of scale.
And you also mentioned Munger's Lollapalooza effect. How does that apply here?
It applies beautifully, I think. The moat isn't just one thing. It's multiple forces converging.
Okay, lay them out.
You've got the low-cost funding from the massive deposit base. That's force 1.
Got it.
Then add the high switching costs from product integration and loyalty programs, force 2.
Okay.
Then layer on the intangible but powerful value of a trusted 240-year-old brand name, force 3.
Trust is huge in finance.
Absolutely. And finally, add the significant regulatory barriers to entry. It's incredibly hard for a new player to get a national charter and build scale, force 4.
So deposits, switching costs, brand, regulation.
Exactly. Each one reinforces the others. The combined effect, the Lollapalooza, creates a fortress much stronger than just adding up the parts. It's synergistic.
Fascinating. Okay, let's shift from the structure to the experience. We try to do some scuttlebutt, talking to customers and employees. What does that reveal about Bank of America?
It reveals a really interesting and I think crucial dichotomy, especially with customers. It's less about customer love and more about, well, tolerated utility.
Tolerated utility. Explain that.
Okay, so on the positive side, customers consistently rave about convenience. The sheer ubiquity of branches and ATMs, plus the quality of the digital tools.
The app gets a lot of praise.
A lot of praise. We've seen reviews saying things like, it's far superior to any other bank's app. Please don't change it. It's perfect. That's real enthusiasm for the tech.
Okay, that's the positive. What's the tolerated part?
The negatives are just as consistent. The biggest complaints. Uncompetitive, often near zero interest rates on savings accounts.
Yeah, that's a common one.
And fees, overdraft fees, maintenance fees, sometimes unexpected holds on funds, billing disputes, and let's be honest, sometimes frustrating customer service experiences. The CFPB has dinged them for things like improper overdraft fees more than once.
So not exactly generating warm, fuzzy feelings.
Not usually,
Yeah.
no. You don't find hordes of customers saying, gosh, I just love Bank of America.
But you're saying this tolerated utility is actually a strength. How?
Because it's the foundation of their low-cost funding. A huge chunk of the public makes a pragmatic choice. They trade off getting top deposit rates or maybe stellar service for the sheer convenience, the perceived safety, and the one-stop shop capability.
They prioritize utility over yield or delight.
Exactly. And that willingness to accept good enough convenience over maximizing returns is what allows BAC to gather those trillions in deposits while paying very little for them. It fuels the whole profit engine. It is the moat in action.
That's a key insight. Okay, what about the view from inside, the employees?
It's a mixed bag, as you'd expect in a company with over 200,000 employees. Depends heavily on the role, the team, the manager.
Sure, but any general things?
On the plus side, consistently good feedback on benefits, health, retirement, tuition help, generous paid time off, and for motivated people, real opportunities for internal career growth. We've heard from long-timers who feel genuinely invested in and empowered.
That sounds pretty good for a megacorp.
It does, but then you get the typical downsides of large bureaucracies. Feeling like a small cog in a giant machine. Repetitive work. Sometimes a lack of individual recognition. And customer-facing roles, like branch bankers, are often described as really draining.
Dealing with people's money anxieties, fraud worries.
Exactly. High stress, emotionally demanding. But, and this is important, you generally don't hear about the kind of systemic, high-pressure, ethically dubious sales practices that plagued, say, Wells Fargo.
That's a crucial distinction.
It is, and the fact that being a great place to work is actually one of the stated pillars of Moynihan's responsible growth strategy suggests management understands that employee satisfaction isn't just fluff. It's crucial for risk management and long-term success.
Right. Happy employees are less likely to cause scandals. Okay, let's zoom out again. The competitive landscape, who are they really up against?
The main battlefield is dominated by the other giants, the big four U.S. banks. It's an oligopoly, really.
Okay, who are the other three?
First, JP Morgan Chase, JPM, arguably BAC's most direct and formidable rival.
The biggest buy assets, right?
Yep. JPM aims for leadership everywhere, especially strong in investment banking and global trading. Many see them as the best managed global bank overall. That's a high bar.
Okay, JPM. Who else?
Then you have Wells Fargo, WFC, historically a U.S. consumer and commercial powerhouse, huge branch network.
But they've had their issues.
Major issues. Still recovering from the sales scandals, still operating under a Fed asset cap limiting growth. A very different trajectory than BAC post-crisis.
A cautionary tale, maybe. And the last one.
Citigroup, CTD's differentiator is its global reach. Massive international network, really focused on serving multinational corporations and cross-border needs.
More global than BAC, which is more U.S. focused.
Generally, yes. Especially on the consumer and wealth side, BAC is very U.S.-centric.
So against JPM's global might, Wells Fargo's troubles, and Citi's international focus, what's Bank of America's key durable edge? Where do they really stand out?
In our view, it's the unmatched scale and, crucially, the integration of their U.S. consumer banking franchise with their global wealth and investment management arm, specifically Merrill Lynch.
The consumer bank feeding the wealth management business.
Exactly. Think about it. 69 million U.S. consumer and small business clients, #1 in U.S. deposits. The leading wealth platform in Merrill, all under one roof, working together.
No one else quite matches that combination in the U.S.
Not with that same scale and seamless integration. JPM's investment bank might be stronger globally, Citi is more international, but nobody combines that massive, low-cost U.S. deposit base with a dominant wealth management platform, quite like BAC.
And that creates a powerful engine.
A very powerful, self-reinforcing, and relatively stable engine. The consumer bank provides the cheap funding and the huge client pool. Merrill provides the higher margin services. It's less exposed to volatile global trading or geopolitical risks than its peers.
Making it a more predictable core franchise.
We think so. It's arguably a higher quality, more durable core business because of that specific domestic focus and integration.
Yeah.
That's their sweet spot.
Okay, that makes a lot of sense.
Yeah.
Let's move to our second pillar, management stewardship and financial resilience, because a great business can still be ruined by bad management. Let's talk Brian Moynihan.
Right. CEO since January 2010, over 14 years now.
Yeah.
And his entire tenure has been defined by implementing that responsible growth philosophy we discussed.
And you see that reflected in his actions and statements.
Consistently. Read his shareholder letters, listen to interviews. It's all about de-risking the balance sheet, simplifying the company's structure, remember the complexity he inherited, and driving organic growth. Not growth through big, risky acquisitions.
He seems focused on leveraging what they already have.
Very much so. Huge focus on using technology for efficiency. Look at the headcount reduction, down from 285,000 to 212,000 under his watch, even while the business grew market share.
Doing more with less, essentially.
That's the goal. He constantly talks about the untapped potential within their existing 69 million clients. Why take massive M&A risk when you can just deepen those relationships?
It sounds like prudent stewardship, not empire building.
That's exactly how we see it, especially given the bank's near-death experience pre-Moynihan.
Okay, stewardship philosophy seems sound. What about incentives? Is management aligned with shareholders?
The alignment looks pretty robust. Executive compensation is heavily weighted towards long-term performance-based stock.
Not just salary.
Far from it. For Moynihan in 2024, something like 96% of his pay was variable, tied to performance, and half of that was in performance-restricted stock units, PRSUs.
Meaning he only gets them if the bank hits certain targets.
Exactly. They're tied to things like 3-year average return on assets and growth in adjusted tangible book value, real long-term value creation metrics. So his interests are very much tied to shareholder outcomes.
What about insider ownership? Do they own much stock personally?
The percentage looks small, maybe 0.2%, but given BAC's huge market cap, that's still over $500 million in stock held by insiders.
So significant skin in the game in absolute terms.
Definitely. And don't forget the biggest shareholder, Berkshire Hathaway.
Right, Buffett, holding nearly 9%.
Having such a large, famously patient, business-focused owner is huge. It anchors the board, reinforces that focus on long-term value, and discourages management from doing anything stupid with capital.
A powerful influence for rationality. Okay, so philosophy and incentives seem aligned. How have they actually allocated capital since, say, 2015 post-cleanup?
The track record has been incredibly disciplined, rational, and very shareholder-friendly. 2 main priorities.
What are they?
First, consistent reinvestment back into the core business. That $3–4 billion a year in tech spending we mentioned, that's the prime example. Improving the customer experience, digital tools, efficiency, directly widening the moat.
Investing where they have advantages.
Precisely. And second, a clear strategic commitment to return essentially all excess capital back to shareholders.
How do they do that?
Through steadily increasing dividends, providing income, and maybe more significantly, through absolutely massive share repurchase programs.
Like the $40 billion buyback authorized recently.
Exactly. That's a huge signal of their commitment. So does their capital allocation pass the rationality test? Absolutely.
They're not hoarding cash, not doing dumb acquisitions.
No diversification. They invest smartly in the core, then give the rest back. Buybacks are great when the stock's reasonably priced. It's textbook rational capital allocation.
Okay, solid management story. Now let's look under the hood at the financials themselves, the financial fortress. How strong is it, really?
Qualitatively and quantitatively, it looks very strong. Since they put the GFC issues fully behind them around 2015, profitability has been remarkably consistent and powerful.
What kind of numbers are we talking?
Net income has been very solid. $27.5 billion in 22, $26.5 billion in 23, projected around $27 billion for 24. That level of steady, substantial earnings points to a high-quality operation.
And for banks, we look at specific metrics, right? Not the usual industrial ones.
Correct. Forget ROIC or debt to EBITDA. For banks, you look at profitability relative to assets and equity.
Like return on equity.
Specifically, return on tangible common equity, ROTCE, that's been a solid 13.4%. It shows how well they use the actual capital shareholders have put in.
Okay, 13.4% ROTCE. What about return on assets, ROA?
That's steadily getting closer to the 1% benchmark, often seen as a sign of a well-run bank. It was 0.84% in 2024. And crucially, both these returns are comfortably above their estimated cost of equity, around 9.5%.
Meaning they're creating economic value, not just shuffling paper.
Exactly. They're earning more than their capital costs them.
Now, you mentioned we ignore free cash flow for banks. Why is that again?
Because it's just way too volatile and misleading. A bank's balance sheet, items, deposits coming in and out, loans being made swing wildly day to day. It makes reported FCF basically meaningless for understanding underlying owner earnings.
So we focus on profitability metrics like ROTCE and ROA.
Yeah.
What else? What's the key safety metric?
Capital adequacy, specifically the Common Equity Tier 1 ratio, CET1.
CET1. Explain that simply.
Think of it as the bank's ultimate loss-absorbing cushion. It's the highest quality capital common stock, retained earnings measured as a percentage of its risk-weighted assets. It's the buffer designed to withstand a severe crisis.
And how does BAC look on CET1?
Very strong. End of 2024, it was 11.9%. That's well above their regulatory minimum requirement of 10.7%.
So a significant safety margin.
A substantial cushion. That's the bedrock of the financial fortress. It signifies resilience against major economic shocks.
Okay, so if we look at the trends over the last few years, say 2019 to 2024, does the data back this up?
Absolutely. Net income, while it fluctuates, shows underlying strength. ROA and ROE stabilize post-GFC cleanup, showing consistent profitability.
What about efficiency? Costs versus revenue.
The efficiency ratio has generally trended downwards, meaning they're getting better at managing costs, likely due to those tech investments paying off. Lower is better there.
And CET1 stayed strong throughout, even during COVID.
Yes, consistently robust, well above minimums, demonstrating that capital strength across different conditions. Even loan quality metrics, like net charge-offs, have remained well managed.
So the numbers paint a picture of a resilient, profitable, and well-capitalized institution.
That's the takeaway from the data, absolutely. It reinforces the qualitative story.
All right, let's pivot to the part every investor has to consider: valuation, risks, and potential catalysts. How does the market typically value Bank of America?
Historically, it's traded like a cyclical value stock, meaning its price-to-earnings ratio, its PE, usually sits below the overall market average and almost always at a discount to its closest, perhaps higher-quality peer, JP Morgan.
What's the typical PE been?
Over the last 10 years, it's averaged around 12.1 or so.
And why the discount? What's the market's logic?
It's pretty straightforward. The AC's fortunes are tied directly to the health of the U.S. economy. Its stock price is very sensitive to interest rate expectations, credit quality concerns, overall economic growth sentiment.
It's a macro bet, to some extent.
Very much so. And lately, there's been that specific overhang we need to mention: the large unrealized losses on their long-duration bond portfolio.
Right, the mark-to-market losses as rates rose.
Exactly. That has definitely weighed on the stock price and suppressed the valuation recently. Creates a perception of vulnerability to rates.
Okay, so given it's cyclical and sometimes discounted, when does a real buying opportunity emerge for a long-term investor? How do you define a margin of safety here?
For a business like BAC, a margin of safety means buying when the price gets significantly out of whack with the underlying value of the franchise, usually because of short-term fear or uncertainty.
What kind of scenarios create that disconnect?
Well, one is just a general market panic, like we saw briefly in March 2020. Everything gets sold off, including high-quality names like BAC, even if their fundamentals are solid.
Indiscriminate selling.
Right. Or it could be a company-specific issue that scares people but is ultimately temporary. Maybe a big regulatory fine that's manageable, or some political noise that doesn't actually change the long-term earnings power.
A temporary cloud.
Exactly. Or perhaps the most classic opportunity for a cyclical like BAC, a period of peak macroeconomic pessimism. Everyone's convinced a deep, long recession is coming.
Fear is rampant.
Right. In that environment, the stock might trade at a steep discount to its tangible book value. That's often a very attractive entry point for someone willing to look past the short-term gloom.
Buying when blood is in the streets, so to speak.
That's the idea. Getting a wonderful company at a fair price, or even a good company at a wonderful price, because of temporary fear.
Which brings us squarely to price as the final hurdle. Because even a great company can be a bad investment if you overpay.
Critically important, especially for a cyclical business. Your ultimate return depends entirely on the future cash flows relative to your entry price.
You can buy the best bank in the world at the peak of the cycle and potentially make no money for years.
Absolutely. Buying BAC when the PE is high, sentiment is euphoric, credit losses are abnormally low, that's often a recipe for disappointment as the cycle inevitably turns.
So the ideal time is?
The ideal time is when the market is excessively pessimistic about the short term. When fear creates that discount, that's when you can buy that durable earnings stream cheap, building in your margin of safety for better long-term returns.
Patience and discipline are key. Okay, let's talk growth. Where will future earnings growth primarily come from for Bank of America?
The single biggest engine, in our view, is deepening relationships with those existing 69 million U.S. clients.
Going deeper, not necessarily wider.
Exactly. Given their market share and integrated model, the highest return path isn't big acquisitions. It's cross-selling more higher-margin products into that massive, somewhat captive base.
Selling a mortgage to a checking customer, a Merrill account to a small business owner.
Precisely. Each extra product sold to an existing customer has a very low incremental cost. That drives operating leverage. Profits grow faster than revenues. It's about maximizing the value of the network they already dominate.
Makes sense. Now the scary part, permanent risks. What could truly fundamentally impair this business long term? The tail risks.
There are a few big ones. The ultimate tail risk for any bank is another systemic financial crisis, one even worse than 2008.
Something that overwhelms even today's higher capital buffers.
Right. Post-crisis rules make it less likely but not impossible. A true black swan credit event could be devastating.
Okay, systemic crisis. What else?
Technological disruption remains a long-term threat. Could big tech, Apple, Google, or perhaps decentralized finance, DeFi, eventually disintermediate core banking?
Take over payments, deposits, maybe even lending.
If someone offered a radically better user experience that fundamentally eroded BAC's low-cost deposit advantage or severed those direct customer relationships, the moat could be permanently breached. It's a long-term risk to watch.
And a third one.
A sustained period of negative interest rate policy, NIRP, in the U.S.
I've seen that elsewhere, like Japan and parts of Europe.
Yes. If the U.S. went significantly negative on rates for a long time, it would fundamentally break the core NII-generating model of banking. It attacks the very heart of how they make money. Very damaging if it happened.
Okay, those are sobering risks. Let's look to the positive side. Potential catalysts. What could accelerate the stock price moving towards its intrinsic value?
The biggest, most visible catalyst already baked in, really, is that net interest income acceleration we talked about.
From the bond portfolio repricing.
Exactly. The market punished the stock for those unrealized losses as rates rose. But that's temporary. As those low-yielding bonds mature or rates stabilize, the money gets reinvested at today's much higher yields.
So earnings get a mechanical boost.
A significant multi-year mechanical tailwind to NII and earnings. And it happens almost regardless of the broader economy. It's just the balance sheet catching up. That melting ice cube of losses turns into a stream of higher income.
Seems like a powerful, fairly predictable catalyst. What else?
Aggressive capital returns.
The buybacks and dividends.
Yes. With that fortress balance sheet and huge profit generation before loan loss provisions, they have immense capacity to return cash. That $40 billion buyback authorization is a clear sign.
And buybacks boost earnings per share, right?
Highly accretive, especially if the stock is reasonably valued. Fewer shares outstanding means each remaining share owns a bigger piece of the profit pie. Consistent, large buybacks are a direct way to drive shareholder value.
Okay, NII tailwind and capital returns. Now, let's try some second-level thinking. What's the common market narrative, the first-level thought, about BAC right now?
The dominant narrative, the first-level thinking, is that BAC is basically a leveraged, somewhat troubled bet on interest rates. The market obsesses over those unrealized bond losses.
The stock moves with Fed expectations and Treasury yields.
Very much so. And the idea of higher for longer rates is often seen as negative because it keeps pressure on tangible book value via those bond marks. That's the surface story.
Okay, what's the deeper second-level contrarian view?
The second-level view says the market is fixated on a temporary, non-cash accounting issue, the bond losses, and is missing the bigger picture.
Which is?
Which is the profound strengthening of the underlying franchise's long-term earning power. That bond portfolio issue is temporary. It resolves itself over time as bonds mature. The real story is that higher rates have massively increased the sustainable NII the bank earns on its core loan book.
So the market is focused on a temporary negative while underappreciating a durable positive.
Exactly. It seems to be mispricing a temporary accounting headwind while significantly undervaluing a structural long-term tailwind to core profitability. The underlying economic fortress, built on scale and switching costs, is likely far more valuable and resilient than the current sentiment-driven price suggests.
A classic potential mispricing based on short-term noise versus long-term fundamentals.
That's the contrarian thesis, yes. An opportunity for patient investors who look beyond the headlines.
Excellent. Let's try to synthesize all this. If you had to summarize the investment thesis, the bull case, for Bank of America on one page, what would it be?
Okay, the bull case rests on a few key pillars. First, it's a dominant and highly durable franchise. Number one in U.S. deposits. Simple, enduring model. Protected by that wide moat, massive scale, high switching costs.
Lower one. Dominant, durable, wide moat business.
Second, excellent stewardship. Moynihan's long tenure, the responsible growth discipline, de-risking post-crisis, rational capital allocation, smart reinvestment, huge returns to shareholders via dividends and buybacks.
Pillar 2, excellent rational management.
Third, that embedded profitability catalyst. The significant multi-year tailwind to net interest income as the bond portfolio reprices higher. It's almost automatic earnings growth built in.
Pillar 3, built-in NII catalyst.
And fourth, the contrarian opportunity. The stock appears mispriced because the market is overly focused on those temporary, non-cash bond losses. It's a chance to potentially buy a wonderful company at a fair price.
Dominant business, great management, NII tailwind, potential mispricing. That's the bull case. Now, invert it. What's the bear case? The red team challenge.
The core bear argument, the inversion, is fundamental. Maybe banking, especially massive universal banking, just isn't a truly wonderful business in the Munger Buffett sense.
Why not?
Because it's inherently hyper-competitive, heavily regulated, brutally cyclical, and often a commodity business. That fortress we described, maybe it's partly an illusion, built during a relatively calm decade with low defaults, easy money, and huge government backstops.
So the bears would say the current stability is abnormal.
They might argue investing today is a bet that this unusual stability continues indefinitely, and that's a big bet. What happens in a real black swan event?
Right.
Like a credit crisis from somewhere unexpected, commercial real estate, sovereign debt, mass consumer defaults, or a tech disruption that makes branches obsolete overnight. Could that expose the inherent fragility of any highly leveraged institution?
Leverage cuts both ways.
Viciously. What works for you in good times works powerfully against you in bad times. A severe downturn could lead to catastrophic permanent capital impairment.
And the opportunity cost.
Exactly. If things go really wrong, you could be stuck holding a highly capitalized utility, earning maybe its cost of capital if you're lucky. A painful multi-decade hold, reminding you of the inherent risks in banking. It's a necessary and sobering counterargument.
Absolutely crucial to consider both sides. Wow, what a comprehensive journey through Bank of America.
It's a fascinating company to analyze.
We've really unpacked the clarity of its business model, the strength of that moat, the discipline that management seems to have instilled, and that complex interplay of risks and potential catalysts. Hopefully it's much clearer now.
And hopefully it underscores the value of that second-level thinking, looking beyond the surface narrative to understand the deeper, more durable economic realities.
Definitely. We really encourage you, our listener, to think about how this deep dive understanding BAC's specific advantages, its risks, how it makes money, might help you analyze other companies, even in different industries.
Yeah, think about concepts like tolerated utility versus genuine customer love. How does that distinction reveal the true source of a company's pricing power or competitive advantage? It's a useful lens.
Absolutely. So as a final thought to leave you with something to mull over, if the true test of a bank is surviving crisis, what really separates a too-big-to-fail institution that's a stable investment from one that's just a ticking time bomb waiting for the next unexpected shock?
Or perhaps flipping that around. Is the market's persistent focus on these temporary, often non-cash accounting issues in solid traditional businesses like banking actually a durable inefficiency? A recurring opportunity for patient, second-level investors who can see the real economic fortress beneath all that surface noise?
Powerful questions to ponder. We hope you'll revisit these ideas, discuss them, and keep doing your own deep dives into whatever sparks your interest.
Thank you so much for joining us on this deep dive into Bank of America. We really appreciate your time and attention, and look forward to unpacking another complex topic with you next time.